you're going to want to have some permanent coverage that it lives with you beyond when you retire from your pilot job. That also is going to be, in the short term, partnering with your desire to build more wealth, and in the long term, protecting your ability to pass it on more favorably.
Welcome back to the Passive Income Pilots, everyone. I'm your host, Tait and Ryan. I'm here with my co-host, Ryan Gibson. How you doing, my man?
Good, Tate. I'm excited to have one of my friends on the show today to talk about a unique wealth building strategy that really diversifies how people look at things. So how have you been?
Yeah. I've been great. Yeah, another week here, just working on a bunch of different stuff. You know, we have our deal open with Spartan Investment Group, which I'm really excited about. We have an additional 2 offerings that we're actively involved in. One, I believe by the time this airs, is going to be active. That's an energy deal. We've been chasing down an oil and gas deal for the last, year, doing due diligence on the topic. Really excited about that. But otherwise, excited to talk to Austin. You know, Austin is not the first registered investment advisor that we've had on the show, but the first one that's really dove into life insurance, which I think is a really interesting strategy.
Yeah. And I think he kind of has I think he calls it the 3 pillars of wealth that he talks about, where, you know, we're heavy in real estate, but typical pilots are going to be heavy in stocks, bonds, mutual funds, because that's what they pretty much can invest in with their 401k. And they have this life insurance thing hanging out there, but they don't really have a wealth building life insurance plan. So we're going to talk about that. And then lastly, kind of just wrap things up, but a little bit about Austin, REA. He's the founder and CEO of Waystone Advisors. They're an independent wealth management firm based out of Redmond, Washington, so not just down the road from me. And they have over a decade of experience working with real estate investors, business owners around the country. And they basically design their wealth in ways that create more control and flexibility to pursue their financial goals. So waystoneadvisors.com is their website. And with that, let's get right into the show.
Let's go.
All right, Austin, welcome to the show. Really privileged, honored to have you. A good friend of mine from Seattle, and awesome to get another RIA on the show to talk about a unique strategy that I think everybody's going to get a huge benefit out of. Whether you work with Austin or not, it's really something to chew on and think about. So welcome to the show, Austin. Thanks
for having me. It's an honor. I've been looking forward to being a part of this.
Absolutely. So I think we met through mutual friends, but what really made a light bulb go off with me is there's not a lot of registered investment advisors out there that are helping investors invest in real estate, specifically real estate syndications or other alternative investments. But, you know, I had the opportunity to sit down with you and really walk through kind of what I feel like is not a unique strategy, but like you really boil it down to like the blocking and tackling of what every investor needs to have in their portfolio to be successful. Can you kind of walk through what you do?
Yeah, absolutely. And I appreciate that. Yeah, from a unique perspective, I think we have quite a few clients who say that we merge traditional planning and traditional tools with more of a real estate and financial independence type process and filter. So that's where we are, licensed. I'm a certified financial planner. Our company is an RIA. We have a broker dealer. We do all of the traditional pieces, the money management, the retirement accounts, the non-retirement accounts, the life insurance, all the other pieces. But we do it within much more of a context of real estate, financial independence, general. How do we create more control and flexibility that is going to be able to create passive income streams, allow you to have outcomes that are going to be less restrictive and more flexible, creating more freedom. So that's where when we work with real estate investors, we do have a conversation around what are your goals? Do you want to be financially independent sooner than the traditional 60, 65? Are you comfortable with the real estate and other assets? Because we believe both on the traditional planning side and on the more real estate planning side that you should have assets that are market-based, assets that are income-producing, assets that are more stable and tax favorable. And if you do them correctly, they should all enhance each other and create more flexibility to be able to achieve your goals the way you want to.
Yeah, and I love that perspective because we have people on the show who are like, don't invest in the stock market. And then they're like, don't invest in real estate, right? Or whatever. So like, I love your blend. You're kind of like, well, let's have a little bit of both, right? Because it's a good diversification strategy. Mm-hmm. And like you said, you kind of have that stock appreciation upside, but mixed with the income side as well. Let's talk about how that strategy kind of merges with like kind of getting good life insurance plans and kind of dive into that a little bit.
Yeah, life insurance is in my mind. So when I talk about the plan as a whole, I like to call it the three pillars of wealth design. So that falls into the stable side if it's done properly. And when thinking about investing in syndications, investing in passive income creating assets, we want to have a partner with an asset that's going to be leverageable, that's going to be more stable to navigate the ups and downs that come with the market, with the real estate. So a good life insurance policy, if it's designed well, it should be having two core components. It should be having a wealth building side where it's building a non-market based, uncorrelated, tax-free asset. Well, there are a variety of different kinds. We don't have to get into depth here, but there's universal life policies that act more like the market, and there's whole life, which acts really more like a savings account that happens to be growing at a contractually guaranteed, consistent rate most of the time that banks feel comfortable with. They're oftentimes willing to lend and leverage at 95 cents on the dollar. So if we're trying to create an extra 2 or 3% return on our investment when dealing with real estate, using a life insurance policy as a pass through that can be essentially a better version of a bank account that allows you to do the same thing you wanted to do anyways and have protection that will protect your family if something happens prematurely. And I think we know any good real estate investor is going to have a large position in illiquid assets long term. So if we also have a built-in liquidity asset, that life insurance death benefit that can help cover estate taxes and have a pre-built, if maybe incomplete plan, but a plan for creating liquidity to pass on assets more effectively, you're able to have a more flexible plan by having built-in protections, both now, long-term, and an asset that's going to be complementary from a leverageable, tax-favorable way of investing into that real estate.
Austin, I'm going to throw myself on the sword here real quick because I had a financial advisor a number of years ago who said, "Hey, we need to set you up a life insurance policy," and this was probably 6 years ago. And I just said, "Okay, sounds good." Sort of trust him. Signed up for this plan. I ended up walking away from north of about $30,000 after a few years of funding it because it was not structured in a way that I could benefit from investing in real estate through it. It was basically set up as a pension for when I was much, much older, and it just wasn't structured correctly. So what are some of the important things that someone needs to sort of know about themselves and then also convey to you before you set up a plan for them?
Yeah, I love that. I mean, one of the analogies to go along with what you're saying when I talk to clients is, we want to, if you're playing chess and you told me what's the next best move and all I can see is the queen, I'm not going to be able to give you the best direction in the next next move to make. So it's, ideally, anytime you're doing life insurance, it should be in the context of the broader plan, not as an island, because that's when you risk creating something that isn't actually working in conjunction with your syndications, with your market-based assets. You also want, you want an advisor who is ideally doing the things that you're doing. I think one of the unique value adds that we have when we're talking with real estate investors is me and my team, we invest in our own real estate. So we are already designing it to suit our needs that happen to work well with the real estate investors that want to be working with us. I think having a funding timeline that's aligned with when do you want to be financially independent, like also when do you want to start pulling on these assets. If it's really soon, you want to make sure that it's cash heavy up front so that you're not waiting a long time to be able to double dip and utilize that money in multiple ways. Most advisors that do this consistently should know that the IRS has rules and restrictions around how much you can put in to certain policies based on somebody's income and kind of insurability and still have that money be tax-free. So you want to be maximizing those so that you have the least amount of expenses for the highest amount of growth within that policy, highest amount of cash value available. So that's those are the broad things I'm looking at, but looking at funding time, how much does somebody want to be able to fund, and how do we make sure that the cash is available in a way that works towards their goals.
Well, Ryan, I know you wanted to jump in there. I'm sorry I stepped on you.
No, you're good. I just get excited about this stuff. So I'm going to fall on my sword now a little bit. I did sign up for a life insurance plan not too long ago. And I stressed the need to be able to pull out liquidity, borrow against it, have the death benefit continue to grow, and eventually the thing to provide, I think, a little bit of cash flow. What kind of policy is that? Kind of unpack that for somebody, because I think it was a really cool benefit.
Yeah, there are. So there's on the life insurance side, there's really renting versus owning is how I like to talk about it. So there's term insurance, which is, it's really like renting. I mean, as we all know in the real estate space, when you're renting something, it tends to have lower upfront and back end costs, lower monthly expenditure, but it's not building wealth. The insurance you get through your employer, or if it's called a term policy, that's protecting and not wealth building, which for the right situation makes sense. But if we're trying to use it as a wealth building tool for real estate, we want to be looking more towards permanent or cash value life insurance. And then once again, we want to structure those. I mean, anybody that looks up whole life or permanent life insurance online, there's only two reactions. There's people that think it's the best thing in the world, and people that think it's the worst thing and maybe a scam. So you want to make sure that you're using it correctly. That's typically going to be, there's whole life, there's index universal life, and there's variable universal life. As I briefly touched on earlier, the universal life policies tend to have their expenses are slightly increasing over time. Oftentimes they have surrender charges where you can't access the money as early, although some companies you can waive that or with special riders and designs to the policies, but they're also going to be more market based. So I'm sure you guys know, and it's something I teach clients is the more a bank is willing to let you leverage that asset, that's a really good hack for how safe is this asset.
Yeah.
So when looking at money in the market, there are tools that maybe we can talk about later that we can access 50 to 70% of that money, but we can't access 90-95% because it has market risk. So similar thing on the life insurance side. If we want to bring in a bank to be able to leverage those assets, a bank is generally going to give a little bit less leverage on a variable universal life policy or an index universal life policy, which means your main option is going to be going through the insurance carrier, which depending on the carrier might not be as favorable way to access that money. But a whole life policy, for instance, because it is like cash, banks will oftentimes lend on it like cash, where you can typically access 90 to 95 cents on the dollar, which is where if you're designing it up front, where your policy has 75 to 80% even in year one, you can get most of that money back out. And that's where kind of go into the owning part. Just like when you buy a property, as you've experienced, like it takes a little bit of time to get that money back from the upfront costs. And that's the same thing with a life insurance policy. There are some upfront costs. You can't access, 100 cents on the dollar, but the longer you have it, the better complement it is to your other assets.
I was just going to say, that's a lot of options. So I'm really glad, that you brought that up.
So I think this is a good moment to sort of zoom out because, this conversation started with sort of three pillars of a great portfolio. And then, I think the life insurance conversation is super, super interesting, but we could probably talk for 3 hours on just life insurance. So can we zoom out and just sort of talk about why that three pillar strategy is the best and the reason why you target that for your clients?
Yeah, having three pillars, to oversimplify it, I say if we want to have multiple assets in a plan that are all growing differently, creating different tax benefits, creating income differently. And if we're doing that, we can weather any scenario. It's just using my plan and using this past couple of years as interest rates have gone up. I have money, certainly I have most of my money I have money in the market, money in life insurance, and money in that income bucket. In the income bucket, I have a handful of it in syndications. I have a handful in private lending, and those allowed me to have some passive recurring income, as well as having some tax benefits from those syndications and kind of the more appreciation on the back end. On the market-based side, while the market was down last year, I've still been able to leverage 70 cents on the dollar of my investment accounts, and I've then used that to then do more real estate, more opportunistic. And my portfolio is, even with it being 40% bonds, is up over 10% year to date, even though it was down last year. So it's allowed me to be able to have an asset that has been able to recover in this current environment. And the life insurance, when the market was down last year, completely uncorrelated to the market in the real estate, it just went up 5 to 6% tax free, and allowed me to then once again utilize that to buy into those assets that were down when when my life insurance wasn't. So it gave me more flexibility to pivot.
And I love that because it's like, you can say, well, I'm diversified by investing in different stocks, bonds, and mutual funds, but you're still kind of playing the market, right? And so you're kind of in this whole other category, two different ways. Uncorrelated assets, just awesome to be in that mixed with being in correlated assets, because the market does really well sometimes. So, I love that balanced approach to investing. So, Tait, I know you're jumping in here and you kind of want to pick that apart a little bit. Anything you want to add?
Yeah, I completely agree with you there in terms of, we talk a lot about, because we're both passionate about real estate, Ryan, about non-market correlation, which I think is one of the most powerful things about investing in real estate and syndications, is the fact that, if the stock market comes down by 30%, tenants don't stop paying rent, especially in recession-resistant asset classes like storage, multifamily, mobile home parks. Aside from food, shelter is, up there on the Maslow's hierarchy of needs. Those checks keep coming in. So what we love about real estate is that it's uncorrelated. But Ryan, as you said, sometimes the market rips and you want that exposure as well, right? So Austin, we're one of the arguments that I have for real estate, for really focusing on real estate, is that as airline pilots, we have huge 401k plans. By the time we're 60, 65, we have millions and millions of dollars in these 401ks, which have to be invested in the public markets. So we have sort of a unintended consequence of being very heavy into public securities. So when you're working with a client that has a massive 401k, let's say a typical airline pilot, does that change the triangle at all when you sort of consider the fact that they've got a lot of money in a 401k that's all invested in public securities?
It certainly does. Every plan is going to be different. If somebody has a bunch of money in the market in 401ks, I would probably focus more on the insurance and the real estate side, trying to balance those pieces out. The other thing, though, that I would really focus on is understanding what's their time horizon for when they want to be financially independent. The big downside for people that are really in kind of our age category, anybody who's under 50, is all of that money in 401ks and retirement plans have age restrictions and limitations on when and how you can use it. I wouldn't recommend this for everybody, but I actually recently took the penalty on pulling out my retirement accounts, and I shifted them over into non-retirement accounts because I can leverage them. And I, after doing a bunch of math, realized that if I can keep that in the market still, but then I can essentially turn $1 into $1.70 and then create real estate and passive income. For me, the math made a lot of sense.
Can you talk about that? Because I think I'm among a lot of people that sort of jailbroke money out of their 401k during COVID, using the what do they call it? Not distress.
Yeah, it was like a COVID relief 401k plan or something like that. Yeah.
Yeah. So essentially, you could take up to $100,000 out of your 401k without any penalty. But I'd love to know the math around that, because that's actually something that I have very, very seriously considered, is just paying some penalties. Because when I look at my overall return over many, many years, I'm doing a lot better on my investments outside of my 401k. So I don't know. That's my own personal situation. I'd love to know the math that you did to figure that out.
Absolutely. And I'll get as specific as I can, although I'm going to add the kind of the extra caveat again that this is not a recommendation for anybody to blow up their retirement accounts. It's because I do tend to think that for somebody to do that, they really have to have a clear understanding of what are they trying to do. They want to know where are they going to invest it in, and then ideally have a team of like advisors like us, a good CPA, a good team of syndicators and other real estate people to make sure that their plan has a high degree of success and a comfort level with leverage. Right. But the high level, when I was doing the math, I was looking at in comparing, if I kept this money and I assumed that it was fully invested until I was 60 or 70 in the market, and then I had to pay taxes in the future because this was all tax deferred money. Right. And then I said, what if I pulled that out now paid those taxes, but then was able to, at that reduced amount, still, have a 70 cents on the dollar line of credit that I only leveraged at 50 to 60% because I wanted to have that buffer anyways. And then I could take that and got a spread, like a net spread of 5%, 5 or 6% between the cost of that line of credit and what I was making on it by investing in, passive or, the syndications or those kinds of things. The big variables came down to what did somebody expect their tax bracket to be in the future? And what did somebody think that they could make on a net basis by leveraging that? Because we're going to keep the money in the market. So I assume those variables actually grew at the same pace, but we were just adding an extra layer.
Right.
To really kind of oversimplify the analysis there, somebody who thinks they can make 4 or 5% net above the cost of covering interest and covering the cost of paying the taxes, if they're on the 24% tax bracket or lower, it was somewhere between 10 to 15 years where they actually had more money than they would have otherwise on a net basis. And somebody who thinks they're going to be in the 32% or higher tax bracket in the future when they start pulling out their retirement accounts, it was as early as 4 or 5 because it's not a dramatically higher tax bill to pull it out now and pay the penalty once you start.
Correct me if I'm wrong here, but like also let's think about what you're doing. You're stuffing all this money away for a future date. And then in order to benefit from that, you're basically selling assets and hoping that you have enough assets to sell and deflate by the time you die. Right. So why wouldn't you take some of that, at least some of it, not all of it, and turn it into something that is producing you real cash flow, real income today that you can benefit from so you can work a little bit less if you don't want to feel so pressured to pick up that green slip or pick up open time or work more, right? Or maybe you can, not upgrade and maybe stay in the first officer seat and not be so stressed out about your schedule and time away. There is way more benefits to this than just, the 4 or 5% premium you're going to get on that withdrawal, right? You're building a lifestyle that I think is like basically the point of like what we're trying to bring people on and get perspectives of, right? Like you're a registered investment advisor. You're, this is what you do day in and day out. And like, I know you're not giving advice, but this is just giving a friendly conversation to what you could do with this and what you might be missing out on. And, when you think about how, like Tait said, we're so long in the tooth on the 401k that we're not getting any today benefits. It's all just in the future, in the future, in the future. It's doing nothing to help us retire early. I shouldn't say it's doing nothing. It's you're saving for the future, but it's not doing anything to really benefit us financially today in our younger years when we have kids and we don't want to have, maybe we want to have more flexibility in our life. And that comes with having more flexible financing or more flexible finances.
So Austin, what did you do with the money that you jailbroke? Yeah,
I actually, so I did it in January because I was like, if I can do it in January, that's going to give me more flexibility from a timing of when I pay taxes. Also with the market being down last year. So actually I recently did this after doing a bunch of analysis because I wanted to be able to know going into it. But also from a research perspective, having the market be down more than 20% like last year, going back the last 100 years, the median return in the stock market, the S&P 500, for instance, is double digits. So I was like, this is a great time to essentially, if I jailbreak it now, I will pay taxes on essentially a smaller amount, be able to reinvest it back into my non-retirement investment account, still catch that upside, increase my leverageability, and then now I'm catching the upside, assuming the market does what it has done the last 6 months, and I'm able to use that money in more than one place at the same time.
And how are you using it in more than one place at the same time? This is through the life insurance policy?
No, in this case, actually, so certainly there's, like the Spartan Capital stuff from the syndications, but from a business liquidity perspective, I like to have a decent chunk in private lending that I can also access pretty quickly. So I have a few different funds that are paying between 10 and 13% that have 90-day liquidity if I wanted to. Mm-hmm. So it's one of those things where if my money in the market that's up 10% year to date, and I'm able to take my cost of credit, it costs about 7.5% right now to borrow on my line of credit. But if I can take that 7.5 and make 10 to 13, now my money, I'm getting an extra 5% on that.
It's a cool strategy.
So a lot of pilots might think, well, hey, I've got my employer life insurance, and so when I die, I'm going to get, I think a lot of different airlines have negotiated excellent, I think what you would consider term life insurance, where they die and a big check shows up based on a multiplier of their currently hourly rates and the highest wide body airplane they can be on, or some kind of a $1 million death benefit or something like that. Let's, what are we missing here? Because doesn't sound like a wealth building activity. That sounds like more of a Band-Aid if you pass, that your children and your family would have something, but they wouldn't necessarily, not necessarily building wealth with that.
Exactly. The term insurance you get through your employer, which is just called group coverage at that point, is a really good wealth protecting tool, but as you mentioned, Ryan, it's not a wealth building one. While I'm not a former pilot, I do have pilots that we work with that we've helped shape their plans. And I mean, any of that free insurance coverage, we say definitely take it. Definitely take that, protect your family. But when you eventually want to not be a pilot, or when you utilize some of these great strategies to build your real estate and passive income empire, you're going to want to have some permanent coverage that lives with you beyond when you retire from your pilot job. That also is going to be, in the short term, partnering with your desire to build more wealth, and in the long term, protecting your ability to pass it on more favorably.
No, that's great. So a lot of nuggets here on just thinking about jailbreaking and thinking about your retirement plan and considerations for your insurance stuff. Do you have any material that people can kind of follow up with, that or guidance on where to go, even if it's your website? I mean, just learning more about these things. I know a lot of pilots are probably listening to this and hearing this for the first time, or maybe the second time, and they're like, man, I really want to do some research here. Where would one go to kind of learn more?
That's a great question. Certainly you can go to our website, which, I mean, being in the industry we're at, we don't have as much on there as we want to, although we're working on building out and adding content, which over the next couple of years, we should have quite a bit more up there. Something we can provide as well is even that, that 3 pillars that I talked about. I know I promised that I would get you a PDF of that to be able to share with our listeners. But also, just as importantly, these are complicated concepts. Like it's tools that people are loosely familiar with, but that need to be done with precision to be able to be done properly. Right. So something we typically offer is a free consultation with our team. So there's me, we have another advisor, we're growing, and anybody who wants to know more about do these things make sense for me? We would prefer to be able to help handhold somebody with learning these things properly, so they don't have to navigate the internet and the different versions of non-tailored education.
Right. Makes sense.
Makes a lot of sense.
Yeah. And on that segue, how can our listeners get a hold of you? What's the best way to get in touch with you? Maybe schedule a call or get a consultation on something like this?
Absolutely. The easiest way would be to go to our website or email us at info@waystoneadvisors.com. My team monitors that and gets back to anybody who reaches out within 24 hours. Once somebody submits a request to meet up, like I said, our team will call or email very, very quickly, as well as coordinate getting what we call our basic discovery form. So that before we meet somebody, we have a general round numbers idea of what are your goals, what's your income, what's your situation, so that we can have a really productive first conversation around what are the tools that could benefit you, what is the kind of relationship that could make sense to help make sure you have a comprehensive plan that leads towards your long-term goals.
If someone already has a life insurance policy, is that good or bad? That I know that RIA firms, you guys have to make money. Most RIA firms make money on commissions on products that they sell their clients, which is fine. Is that how you guys work? If someone comes in with a life insurance policy that's already built, is that a negative because you don't get to build one? How does that work?
That's not a negative at all. The benefit of being owner of Waystone Advisors, an RIA is certainly one of the structures that we use for being able to manage money, but we have the licenses to be able to do a fee for a plan or consultation. Although I'd say the vast majority of clients that work with us actually engage with us to manage their assets and set up insurance. But we have many clients, even a client I was reviewing this morning that already has long-standing permanent life insurance that we say, great, we'll do an analysis and we'll see, one, was it designed properly? Is it the best version that it could be? And if it is, then we'll incorporate it in the broad plan, and then we'll just build off of it and add other assets to it. But for policies that aren't built well, I mean, just like in the real estate world, where's the 1031 exchange, in the life insurance world, there's a 1035 where it's possible to take cash values and shift them and kind of jumpstart a new policy. So part of our analysis is looking at, do they have the right pieces and are they designed properly?
That's great. That's really great.
If I can tell a kind of brief story on that, it was actually Ryan, one of our mutual connections. When I first met with them, we had a quick phone call and they talked about the things that they were doing, the lines of credit, the investment account, the life insurance. And I was like, hey, you know what? Face value, it seems like you're checking all the right boxes. But let's, if you're open to it, we can have a 45-minute. Let me actually look at how they're designed. And we looked at it, and on the life insurance side, the life insurance policy they had wasn't projected break even till year 14. And I said, well, we could design it to be break even by year 5. And their life and their investment account was designed to be not intentionally designed to be leverageable, so they weren't able to have as high of a line of credit as if we were to take it over and restructure it and manage it. So even people that are doing the right things, oftentimes it's worth doing a review to see if those right things maybe could be tweaked to be more efficient.
I just love that because there are not a lot of advisors. They're so singular focused. They don't have a global perspective. And that's why, Austin, why you're on the show is you have this unique ability to understand that it's not just about stocks, bonds, and mutual funds. There's a much grander scheme here. And I just love that. And I love how willing you are to sort of hey, somebody might think that they've got it all down. And then it's like, hey, no, let's pop the hood and just make sure and really fine tune the engine to make sure you're getting everything you want out of this. And the other part that I love is I have consultations, and Tait has consultations with investors all the time. And it's like finding out, it's usually like a money finding mission. It's like, where is the best place that I can pull cash from to get into your deals, right? And so, it's a combination of TSPs, maybe leveraging a life insurance policy, leveraging a taxable account. It's cash. It's, converting an old IRA into a self-directed. There's like so many different ways. And I think just having someone like yourself really helming the team of, for your family and your financial success is so beneficial to people. And, and I just really appreciate, everything that Waystone does. And, which is why I was excited to bring you on and talk about all this stuff. Cause it's, use the resources you have, on the last episode, we talked about this book, Who Not How, right? So instead of being the, if you haven't read it already, good book, but instead of figuring out how to do all this stuff, Austin is a great that knows how to do the things that you're trying to do, which is kind of optimize your investment portfolio to be well structured in a way that you could be beneficial with. So really like it.
Well, I appreciate that feedback. And just to add to that, I think a lot of how we got connected and thinking about planning and wealth building is also that abundance mindset. I love all the resources that you guys work to build and the way you're looking at figuring out how do we structure things to be able to give more back to the investors. And that's a lot of how Waystone grew to be what it is we wanted to find a way to bring more tools and more unique kind of innovative financial processes to people that aren't billionaires, that didn't know that you could use lines of credit and set life insurance up certain ways, and that they could potentially have access to real estate and things that I think the average person oftentimes finds themselves believing that, only rich people get to do those things. Yeah.
One question we've been asking every guest now that just to kind of wrap up the talk is in the last 6 months, you've learned something new about investing, financing, whatever it might be, that you haven't shared with anybody yet. It's been on your mind. You've been thinking about it. What is that thing? What is that one thing?
That's a great question to just jump on me, Ryan. If you'd asked me 6 months ago, it would have been jailbreaking the 401ks and all of the math that I've been working on and keeping to myself on that because I wanted to roll that out. Things that I've learned. I see more philosophically. I think the last 6 months has been a reminder of the importance of managing your emotions and expectations when you invest, and realizing that the current environment, right now with interest rates and inflation and all of the the media talking about recession, not recession, and understanding that if we're doing things intentionally, working with the right the who's that can do the what's and know how, we're going to come out the other side.
Yeah. We talk a lot about being a speculator versus being an investor on the Neil Bawa episode, number 14 or something, or 13. We talked about people who are like, well, I'm never investing again with you, or I'm never investing, in real estate because I had one bad experience. And it's like, you got to be an investor. You got to be, you got to have an approach to investing in all points of real estate, of the cycle, or you're just a speculator and you're going to always be waiting for the perfect time to jump in, and it's never going to come. Right. So, and then, being emotional about that is really hard. I think episode 1, actually, with the guy Adami, we talked about that a lot, right? Like just having a plan and sticking to it, was really good advice. So,
well, that's much easier to do when you have an advisor on your team, so that you're not, at the whim of your emotional wins.
Yes, we get emotional. We like to be day traders and, make lots of decisions here. So having Austin in your corner is perfect for that. So, well, we've taken a lot of your time. Appreciate you coming on and sharing your wisdom. And we'll drop your contact information in the show notes. And I think you said you had a PDF or something that you wanted to share. Want to drop that in too, or is that?
That sounds great. Yeah, I'll work on having the team get that over to you.
Perfect.
Get over to you. We can upload it. Yeah.
Awesome. Well, thanks for coming on, Austin. We'll catch you on the next one.
I appreciate it. Thank you both for having me.
Take care.